Hello, everyone. Welcome to Rising Edge TV, your D&O channel. I am Philippe Gouraud, the CEO of Rising Edge, and I have the pleasure of reopening today a D&O file. And today we'll be discussing the FTX case. To do this today, I have the pleasure of having with us Ed Smerdon. Ed, you are the founder of Coverage Matters and a D&O coverage expert. We also have Swifty, or should I say, Jonathan. Jonathan, you are a journalist with the Insurance Post, and you will be bringing us your investigative mindset to the table. And we also have with us Owen Dacey. Owen, our very own Owen Dacey, you're the General Counsel and Head of Claims at Rising Edge. Thank you to the three of you for being with us today. So FTX. What are we going to do today covering in these D&O files? Well, one, we're going to try to find out a little bit more about what the case was about. We're going to discuss the implications from a director standpoint. We're going to discuss whether a D&O policy in similar circumstances, how would it respond to certain the circumstances and the claims that were made against the directors, or maybe will not respond to similar circumstances. And then we're going to find out, if there are any lessons to be learned from a corporate governance standpoint. So it's a big agenda. We'll try to cover all of that today. But to start and to bring everybody on the same level playing field, Ed, could you tell us a little bit more about the case and bring us up to speed on the matter?
Yes, and thanks for asking me to come on here with you. So FTX was a cryptocurrency exchange, complex business, trading in cryptocurrency, linked to another company, Alameda Research. The two became interconnected, really because the driving force behind these companies was a man called Sam Bankman-Fried, who became a household name. And he ran this first company, Alameda, as a trading firm for cryptocurrency. And he then expanded into the exchange, which was FTX, and went through a very rapid period of expansion, gaining a lot of investors. It wasn't a listed company, but it had a lot of private investment and some big institutional investors. And during the course of 2 years, it became one of the largest cryptocurrency exchanges in the world. Very complex business. Not a lot of people understood everything that went on. And of course, it was a quickly developing picture. Mr. Bankman-Fried himself was not a businessman. He was a very clever man, very clever crypto man, but he wasn't really a businessman. And he surrounded himself with similar types of people. And as the company expanded rapidly, it started to experience issues with cash flow, that sort of thing. Had a lot of illiquid assets. And there were some concerns raised really in 2022 about the liquidity of these companies. And certain investors started to ask questions, too many questions. It sort of really culminated in November of 2022 when CoinDesk reported that Alameda Research, which was the company that Bankman-Fried had started originally, held a huge amount of the FTT tokens, which were the tokens traded by the FTX exchange. And that tended to suggest very strongly that there was an unhealthy interconnection between the two companies that went a lot further than the investors or anybody else knew. And this sort of spooked the crypto market completely. And for a while, the crypto went into free fall. And it had a profound effect on the global market for crypto. So at that point, a rival company, Binance, was looking at acquiring it, and they looked into the company as well and looked under the bonnet and didn't like what they saw and pulled out of the deal. And crypto plunged even further as a result of this. Suddenly there was a crisis in confidence of the whole crypto concept, not just FTX. And there was a run on the bank, effectively. A lot of the customers of FTX wanted their money out. And of course, as we know from other collapses, famous collapses that have happened in the world, a run on the bank is about the worst thing that can happen to a financial company. And within days, it was in bankruptcy. So it went from really being one of the world's biggest exchanges. Within 2 years, it was bankrupt. And so on November 11th of 2022, it filed for Chapter 11. And so it's almost it's a bit like Enron in a way. Enron was a huge sort of totemic collapse. And I think FTX, although it was a smaller collapse, it's one of those names that we will remember for a long time because of the speed in which it went under, and a lot of the salacious stuff that came out afterwards. And I think we'll probably move on to that part now. But it was really what's happened since then. Mr. Bankman-Fried is in prison. That's really the current position. But there was quite a lot that came out in the meantime.
Thanks, Ed. So basically, it's a bunch of geeks. They get together. They're very clever. They seem to be a bit disorganized in what they're doing. Whether they were very ethical or not, that's something that maybe, Swifty, you investigated on. So what do you think was the situation there?
Yeah, I think, obviously, I think that it's already been mentioned by Ed. I think Coinbase really was the trigger here, and they're reporting into the kind of the Alameda, the sister company of FTX. I think it's very interesting when you look at these kind of organizations. Obviously, it's very much that startup culture, and it did seem that Sam treated like the money as his own. I mean, he was basically using the kind of money that were investors' money or the kind of business's money to basically invest in various things to use for his own personal gains and personal interests. And
they had a pretty cool headquarters, no?
Well, exactly. It is this thing is that they basically were like these kind of geeks, as I think we called them earlier, who were living the high life. I mean, this company grew kind of exponentially, very, very quickly, much quicker than they were expecting. I think I read somewhere that they were still using for their accountancy software. They were still using QuickBooks, and they were basically approving invoices by Slack, and they were still acting as if they were like this small little startup company when actually they were this massive kind of global name. As a journalist, you always sometimes think, is it too good to be true? That's one of those things. You suddenly go, this is growing so quickly. How is this happening? And then you put in that you've got Bahamas here. It's based in Bahamas, and obviously that regulation is probably a bit more light touch than if it was over here. And as a journalist, it starts triggering these little things. And you just look at the characters, and you kind of look at these people, and you look at Sam, and you go, would I trust this man as a CEO or the kind of figurehead of my business? I mean, I can see how he could be like we said, a very clever kind of he's a geek, he's an entrepreneur. But do I really trust him to run this kind of business which is growing, and is becoming a quick growing, a very, very, very kind of, business worth millions and billions of dollars, allegedly.
He became also a bit of a media star, no? In terms of like a journalist, I also loved him. Well, I brought him on TV shows, right? I mean, it goes a bit both ways.
Well, it is. I mean, he was. I think it's box office, isn't it? At the same time, you might not want him to run the company. If you're a journalist, he's brilliant. He's brilliant. You give him the quotes. It's like there's always the kind of salacious rumors that are always about the company and what was going on. There's always gossip here and gossip there. What was going on? What's true? What's not true? These kind of figures trying to make journalist life heaven.
And he was quite free with his language as well. He was not really afraid of. He wasn't trained in how to handle the media. He wasn't warned about what he should and shouldn't say, really. And he would be very open about his thinking about certain things, which I think in the end didn't help him at all. He was essentially a rabbit caught in headlights, I think.
Ed, as you say this, and we're not going to go there, but you could actually interchange his name with other kind of high-profile figures that are today in the media or kind of really influential in world affairs. I don't want to be kind of like find myself with a suit for slandering, but I invite people to think about that. So back to you, Swifty. So in terms of like, you think that a number of like red flags were kind of like missed early on or through the process?
Well, I think ultimately, I mean, we'll obviously go on to talk about kind of perhaps the kind of D&O and the insurance implications. But, I think, when you have these businesses that grow that quickly and you like saying, it just seems that the people running it are literally having a party. They're having fun and they're not really thinking about kind of, the investors and what it actually means. That they just basically, they're running the business the same way they were running the business when it started up, as when it was very big. The red flags that were missed. I mean, I think we were talking about this beforehand, the fact that they managed to even attract big blue chip investors. People like BlackRock invested in this company, in FTX. They were there. And we were saying, well, surely BlackRock must have done some kind of deep investigation into this business. But I said, I think it probably was FOMO. They were thinking, well, if we don't get in there quickly, somebody else will beat us to it. We need to get in there. And so even these big blue chip companies were just kind of, again, they were just caught up in this, you said the rabbit in the headlights. I think there was lots of rabbits in the headlights here. And they were all basically thinking, we can't miss out on this. This could be the next
the
big.
FOMO factor.
It's a total
fear of missing out.
Total and utter kind of FOMO factor. And it seems like it's kind of, gripped all these people for a very, very short amount of time. This went from like boom to bust very quickly. I think, as Ed mentioned, this happened very quickly. And it was very interesting. Again, we talked about the fact that, there was a company there, seen as a potential kind of, takeover. And they looked at it. It took a day. I think they looked at it for a day. And then basically, one day they were in talks. The next day they were out of talks. But whatever they saw under that bonnet was obviously not very, very nice at all.
It was Binance, right? I mean, and I think one of the interesting aspects of it is that, and I'll be turning to you now, Owen, is, the consequences. Because in this case, as Ed described it, it's a company, grows very fast, super successful, all over the press, and then bang, big bang. But that big bang, there's allegation of fraud. Mm-hmm. So it's not only about negligence, mismanagement, but also like serious allegations of fraud that actually led SBF to be thrown in jail, I think, for a period of like 25 years.
25
for a fraud that ranges between $8 and $11 billion, right? I mean, and defrauding customers. So serious allegations. So can you give us a little bit of colors in terms of like how ugly did it get? Once the serious, the equivalent of the fraud office got involved. So give us a bit of.
Yeah, so ultimately, I think you had, in this case, multiple, at the beginning, multiple regulatory agencies kicking off investigations. So that was all happening pretty quickly, as in addition to the bankruptcy, the Chapter 11 proceedings that Ed was mentioning. At that point, it's all just allegations. When thinking about the D&O policy as well, those types of investigations will trigger cover in the first instance for people's defence costs. So SBF, as they used to call him, he would have been incurring and seeking coverage for that under the D&O policy, I expect. And really, you don't get to that point of the fraud being proven really until the end of the trial. So, or in the case of some of the other characters involved, an admission of some kind of guilt. So if you think about the D&O policy, yes, it'll be covering those costs of those investigations. They're all kicking off at the same time. But ultimately, when there is a finding at the end of guilt, that he was guilty of this fraud, then the D&O policy won't respond anymore because of that final adjudication, if you like, that there was a fraud. And in fact, what might occur, and I don't know if it has occurred in this case, is that the insurers under that D&O policy may have a right to go and claw back those costs. So yeah, that's in the mix when this is all going off with the D&O coverage as well.
But because there were quite a few people that got eventually dragged into this case and being investigated, and they were all relying on one set of the same set of policy, or did you? What do we know about that?
So it's quite rare, but in this case, it did become public. The public did become aware of what was going on with the D&O policies in this case because there were legal proceedings that were kicked off. So yes, what we understand was in place was 20 million of cover. For that, which I was actually quite surprised, given all of the other failings we see here, that they actually had the nous to buy the cover in the first place. But anyway,
but at $1,000 an hour,
double it.
Double it. Okay, and times number of people involved.
Exactly.
I mean, within a week or 2 weeks, they must have run out of limits. No.
Yeah. So that did happen. Again, it's been publicly reported essentially that you had, under the policy, that it's first come, first served most of the time in terms of who gets to erode the limit first. It was knowledge. What came out was that Sam Bankman-Fried had basically spent a load of the limit already himself. And in fact, he ended up, and I'm not entirely clear why or what happened, but he essentially sued the insurers for refusing to continue to pay those costs. What you also had was another director saying, essentially what's happened here is unfair and it's to my detriment. So basically what happened was the first two layers of insurance paid their limits, and then you had the second and third excess insurers in a bit of a pickle, not knowing quite what to do in terms of how to pay out those limits, because they had a dispute there between the directors. So it went to court, and they essentially went to the court saying, can you help us, tell us what we should be doing here in terms of how we're supposed to pay out these limits, because there are different views on how it should be done.
And it's a particular problem in America where there's inadequate limit, and you've got competing interests for the policy. You've got all of the directors trying to get their defense costs paid at the same time. Clearly, there isn't going to be enough to go around. It becomes a terrible squabble as to who can access the policy, what they can get paid, and the insurer has to be very, very careful in that situation that it isn't seen to be preferring one person over another without any good reason or exercising any sort of discretion. So, which is why Owen said, really, it's a first come, first served thing. They just pay the bills as they come in a strict order, and they don't vary that. And that way, it's entirely fair. But it's possible that if the insurer is criticised by the court in the way that it's paid out some of these costs, that it could be exposed above its limit. So that this is the risk for the insurer in not paying out in the right order, is that the court in America might order the insurer to pay the costs even though the limit has actually been exhausted. So that's a pretty scary thing for the insurer, and it's a situation that happens in some countries, but not here. I don't think. I haven't really seen a case of it happening like that here. But 20 million was never going to be anywhere near enough. So you said, Owen, that you're amazed they even had it, and I think there's a point there. But then, of course, they had it, but they probably bought it. The cover limit, they decided that limit when they were a much smaller company, and no one actually thought to treble it or times 10 even, So as the company grew quickly, took on all that investment, and the risks went up, there was no one saying, or apparently saying, 20 million isn't enough. Well, perhaps there were people saying that, but it got ignored. This was all part of the incompetence, and obviously there was fraud as well. But these guys were not experienced business people. They probably thought they were walking on water. They would never have a problem. And so let's not waste money on a D&O policy, a huge limit. Let's just get a basic limit, 20 million, and let's see how we go.
It's like buying the cheapest car insurance on the aggregator. I'm not going to need that. I'm not going to have a claim, so I might as well just buy the cheapest cover. It might not be fit for purpose. I don't care.
No, exactly. And I think that again, it was a rapid rise, and I think that's probably another reason why the limit was inadequate. Some insurers wouldn't have covered them. I think that's the other thing. If knowing the market, a bit like banks, there's a lot of caution around crypto, rightly so. Yeah. And so maybe they tried to get more limit and couldn't. I mean, that's another question. Yeah. What I understand actually happened is that the primary insurers and the first excess layer insurers paid out, but then when it got to the third layer, the insurer was trying to look at the dishonesty exclusion, even though there hadn't been a final adjudication, which was why there was a hesitancy at that point, and they got sued. Which is a really sort of, to your point, Owen, the insurer doesn't really have a ground to withhold the cover on a suspicion. There has to be a final adjudication, and but by then, of course, it's too late. The money's gone, and there is a right to claw back, but are you going to get any of it? I think Bankman-Fried said that he had one credit card and 100,000 in the bank at the end of it.
I was thinking about this too, and thinking we'll get to it in terms of what the current position is now. But it did get me wondering whether, given the amount of assets they have recovered, whether that they might be coming back to ask for that money back. I don't know.
Yeah.
But precisely, we're getting there actually because a recovery process was instigated. I think Kroll and Associates were involved to go and claw back some of these assets. So how did it net off in the end, or as of today? What's the actual loss sustained by the defrauded investors?
Well, I think the figures have ranged a bit. The people were talking about 8 billion in terms of the whole, but I think that last time I checked, it sounded like people who had lost their money were actually going to be getting more money than they lost in terms of the dollar amount. So it was something like $1.90 on the dollar or something like that. But there is a dispute now around the fact that, oh well, it was a Bitcoin. I should get it was worth $20,000 then. It's now worth $80,000. So that's my loss. But what they're saying is no, it's the dollar amount at the time that's your loss. So, but that's another dispute coming now in terms of people getting their money back.
So how you allocate what's been recovered?
Exactly. Yeah.
Interesting.
So it looks like the clients, the customers, the people who entrusted their money to FTX to invest for them, it looks like they will get all their money back, like you said. The people who have lost are the shareholders, the people who invested in the company in the first place. Of course, the company went bust. So in any bankruptcy, it's the shareholders. They don't get their money out. That's the risk you take as a shareholder. That initial investment, you don't get it back. And there would have been no point in some sort of securities claim by the investors because there have been no assets in the company to cover them, and the D&O policy was exhausted by criminal defense costs. So there really is nothing there for those people. But the customers of FTX look like they're going to be fine. Yeah.
Swifty, when you look back, like now with like 2-3 years after everything started to unravel, what are maybe the key kind of salient points of this matter that actually you would have loved maybe to be directly involved in at the time?
Well, I mean, I think you'd like to have been, I suppose, in on the inside, with some good sources, meeting you in dark alleys or in the pub or giving you tip-offs. Because there probably was a lot of kind of stuff going around at this time, probably a lot of kind of things leaking here and there, like we've said, there was a lot of interesting characters involved in this kind of collapse. I mean, I think what's quite interesting is it seems to me that, at the time, everyone thought crypto was done for, or thought they thought this could be a real hammer blow to the sector, but it seems to, from what I can tell, bounce back pretty strongly ultimately. I do think, if you look at the kind of sector now, there's probably are more controls around it, and I mean, you can probably talk from a D&O basis about what happened to D&O rates in this space and what the limits are now and what the market's like. But, obviously, I write about insurance, and I did see this going on and kind of in the sideline, and I keep picking up things about what the insurers is going on and what was going on with all the different covers. But yeah, I mean, I think in insurance, there are kind of collapses that are kind of similar, that companies that were too big or looked too big to fail, and then they did. But I think it's very interesting. Ed touched on this, how quickly it just unraveled. It just unraveled so quickly, and it seemed like every day there was something new happening. I think ultimately there will probably be, I know documentaries being made about this. There probably will be a Hollywood blockbuster. I'm sure, Mr. Bankman-Fried will end up writing a book about this, which will go on to sell a lot of copies and
to repay the insurance.
Yeah,
yes.
But I think ultimately, when this is all said and done, I mean, the only people who probably come out this, worse off are the investors. He's saying, because of the people, the kind of people who had the currency, they're going to get their money back. I think Sam will end up coming out and making money, as these people tend to do for whatever reason they will.
So there were also some collateral damages on that in this case, if I'm not mistaken. Some of the celebrities that were actually promoting FTX ended up also dragged into the consequences of it because they promoted effectively a fraudulent business. So what coverage do you think these people kind of benefited from when they were actually also being investigated, also brought in maybe in a court of justice to answer why did they promote a fraudulent business?
Well, I certainly don't think they'd be covered under the FTX policy, that's for sure. No. But the question there, and actually it's a question that comes up with frauds actually as well, is that in what capacity were they doing that? Were they just doing it in a kind of individual capacity? They might have been, as a celebrity, they might have had a company they'd set up that were doing these kind of things under. And yes, well, maybe they did buy some D&O cover under there. I don't know. They may well have done, but no, it certainly wouldn't have been covered under FTX. But perhaps if they did buy their own D&O coverage for a kind of company they'd set up to do these promotions, then maybe.
So maybe there's a little quick message to all the influencers of the world is that, check who you're actually promoting, right?
Or if you're Tom Brady, then you don't mind paying $2,000 an hour out of your own pocket. I don't know as well.
Okay.
Yeah.
That's true. They were very wealthy people. I suppose, I mean, they were duped, really. I don't think there was any suggestion they were on the inside and knew what was really happening. I don't think anyone knew what was really happening except for a very, very small group of people in the middle around Sam Bankman-Fried. He knew what was going on. And, we haven't really talked about what he did, but it was good old-fashioned embezzlement, really. I mean, he was essentially funds that were entrusted to him by customers were then used to buy things or to prop up Alameda. So houses, donations to charity and to politicians, and he kind of used it as a personal piggy bank, basically, the money that was coming in from customers. And of course, as we all know, it wasn't his money, it was their money. He was entrusted with it. And there are very strict obligations around trustees when you're looking after someone else's money. And it's an extremely serious matter if you then start to breach those obligations and use that money for some different purpose, which is unauthorized, which is what he did and others did. So it's an extremely serious offense. And I think that his defense appeared to have been, I didn't knowingly steal funds. I just thought I could just take the money. I just didn't think I was doing anything wrong. It was, and a jury, obviously, or a judge. I wasn't sure this was a jury in this case or not, but there was.
Can't remember.
Anyway,
Yeah.
Whoever was adjudicating the case didn't buy the story, and he was found guilty and sentenced to 25 years.
But with the benefit of hindsight, it looks so enormously obvious, right? So from an investigation standpoint, Swifty, one cannot not but think in terms of where was everybody? Where were the regulator? Where were the auditors? Where were the investors? In terms of so do you have maybe some comments around that?
Well, no, I think this just became like a cult of personality around Sam, and I think that all these other people, and ultimately they all kind of they all thought, look, we got away with it when we were this big, this size, and they got a bit away with it when we're this big. And I think, as Ed said, I think they just thought this would just carry on forever. This was literally, they could keep dipping into this piggy bank. Like I said, there seemed to be no audit. There seemed to be very little control here. I mean, again, the business was based in the Bahamas. I don't know really how light touch the Bahamas regulation is compared to what they've got in the US. But I understand it's much more lighter touch, and it just seemed to be that he got away with it, and he kept getting away with it, and he got away with it until he didn't get away with it, and then, like you're saying,
the bankruptcy lawyer who was appointed to run the company when the balloon went up to investigate what happened, the restructuring lawyer, a guy called Mr. Ray, who's very experienced and has wound up a lot of high-profile companies.
Including Enron, I think, as well.
Including Enron. He was the Enron. I mean, there's no bigger liquidation in history than Enron. So you've done that one, you can do this one. And when he was appointed, and I don't know whether it subsequently changed, but he said he had no confidence in the numbers. And as far as he was aware, there had not been an audit. There were no auditors. I mean, that was one of his initial comments. So it may be that subsequently it was found that there was some auditing going on, but nothing like what you would be expected to have as a public company or a bank or something like that. You know, nothing like that. Yeah.
But how is it even possible? I mean,
how's that
it's
even
mind-boggling.
Right.
So, Owen, do you know if any other parties eventually got dragged into the aftermath in terms of for negligence, for lack of oversight?
Yeah, well, I think there were certainly some other parties. I don't know if any professional advisors, put it that way, being dragged in, but there were certainly some other entities that had close links to FTX who did have, I think, SEC investigations and regulatory actions, which I think resulted in fines as well. So, yes, the tentacles were out, and there were others that got. And this is very common in these types of things. Again, it's not just that entity suffering that event and the people in there. It does tend to sort of leak out, normally to the auditors if they are there, or other people with close links. Yeah, I've seen it multiple times on claims too. I've seen guys get arrested coming off a plane to be asked questions by the SEC when it's nothing to do with the company they're at. These things really do have a tendency to leak out into other parties.
What about corporate governance in all this? And what are the lessons that we can learn from the case? Let's try to keep it short. I think the list can be very long here, but what are the obvious kind of
have some corporate governance would be a
Right.
start.
That is a start. Very good.
Yeah, I mean that's it. I think that this was the Wild West, the most extreme case that I can think of, really, in terms of the lack of internal controls, auditing, etc., or the lack of external controls as well, in an industry that doesn't have very much, and this is the risk. Normally, it is the auditors that are entrusted by the investors and by the government to watch what happens. That's their job in these companies. And if you don't have a proper audit function, that's your first line of defense gone.
I think clearly all that crypto space is still in its infancy. It was even more so 2, 3, 4 years ago at the height of FTX. So the increased regulatory environment in which kind of like all that crypto space needs to operate is probably also one of the resulting consequences of the FTX. And as often, regulators respond to crisis by implementing new regulations. Which is kind of in that case for the better. But Owen, in terms of like governance, there is a trend now, indeed, in terms of like looking at how I would say normal commercial companies are actually using cryptocurrencies as part of either their asset management or in terms of like their means of trading. So from an D&O underwriting standpoint, is there more scrutiny now, do you reckon, from underwriters in terms of understanding how companies are actually using crypto assets or techniques in the course of their normal business?
Yeah, well, I think it comes back to the point around this it being still a kind of a nascent industry. I think with any industry like that, or any connection to like crypto being a nascent kind of industry, has a kind of cooling effect on a commercial D&O underwriter, because it's probably still feeling some of the effects of the reputational fallout from it. So yes, I think what you would see with a D&O underwriter, they see that word, or they see the involvement in crypto, or whatever they're using it for something. I would certainly think it would raise an eyebrow, and they'd have some questions to ask around controls and risks to do with their use of crypto or how they're involved with it, for sure.
It's not unusual to see crypto exclusions, not on D&O policies, but on other types of insurance. And the theft of assets is classically covered by a crime policy. And of course, I'm pretty certain FTX didn't have crime insurance, and they wouldn't have been able to get it either, because generally speaking, crime insurers don't want to cover crypto. You can buy specialized products for crypto, so don't let me mislead you there. But it is possible to buy crypto crime cover, but it's a specialized area, and you're not going to get crypto cover under a general crime policy. It's going to be excluded, or it's not going to be one of the assets that is covered under the policy.
And maybe not for $8 billion in limits.
Quite right. Wouldn't have been anything like enough, quite. Or there would have been an enormous retention, a huge retention, so that essentially it was only going to pick up, the very top bit of that, perhaps, So it's there wouldn't have been crime insurance here.
So, Swifty, when you consider everything that's just been said there, where is the next hotspot in terms of like what are we missing out today? What are we blind to? Where is the next formal behavior? Do you where would you look?
Well, I think one obvious area is the use of artificial intelligence, and obviously that kind of learned intelligence and how it learns and what it learns and what that potentially opens up, and how you can basically underwrite something that's constantly evolving. So the use of AI potentially, I think, is an interesting area for insurance companies to watch, particularly those companies who are covering. But like you said, crypto is still very early. It's still, this is still like it's literally probably out of a nappy now, and it might be taking its first steps, in the world of business. I think this area has still got a long way to go in how it develops. I mean, like Ed said, he's that there are products out there, but there probably aren't that many, and there aren't that many companies that are really specialising in this area as it stands today. But I think you look in the world today. I think everyone's talking about artificial intelligence, and then quantum computing. That's whatever's coming next, and anything that basically it's this whole thing about the AI learns thing and how it learns and decisions that it might make, and does an underwriter know that it's making these decisions, and et cetera, et cetera, et cetera. I think there's a very interesting area that might potentially come from insuring businesses that are using AI.
Thank you, Swifty. Ed, Swifty, Owen, thank you very much for being with us today. I think it is now time to close this file and move on to the next one. Join us again for another episode of the D&O Files. Thank you.